Hello, my name is Kristen Radish of Arbor Research and Trading, and I will be hosting our new podcast series, Talking Data, which is a series of conversations hosted by Arbor Research featuring Jim Bianco of Bianco Research and Ben Breitholtz of Arbor Data Science. We will host a series of discussions which will offer timely insights into macro data and its impact on the economy and markets. Arbor Research and Trading is an institutional research and brokerage firm that produces innovative research across a broad range of global fixed income, equity, currency, and commodity markets. Bianco Research and Arbor Data Science are our two most prominent research offerings. In today's installment, Jim Bianco and Ben Breitholtz are going to discuss inflation in the markets. And with that, I will turn it over to both of you to get started.
Good morning, Ben, or good afternoon, I should say. We need to talk about what next for inflation. Tell me, what are you seeing in terms of inflation expectations and in some of the market measures that you look at, say the inflation caps and floors and some of the other things as well, too?
Yeah, so just like TIPS break-evens, which have been pretty much on a nonstop tear of widening until just recent days, until we saw the Fed minutes, they've been telling a story of a left side tail that's totally evaporated for CPI. So we have a condition where all break-evens 5 years on out have pushed above 150 basis points. That's exactly what markets are beginning to price in. Our favorite metric that you just brought up, inflation swap caps and floors, showed probabilities above 70% that CPI for the next 5+ years will stay above that 150 basis points. And the issue here, though, going forward is, can we get to that 2% hurdle, the one that you've talked about so much regarding the Federal Reserve? And then right now we've seen probabilities in the past couple of days precipitously drop away from 50%. So the bottom line is markets were smelling it, and now all of a sudden in the past couple of days it's kind of gone away.
Well, let me bring up something regarding that. In that, if you look at who the buyer is of a lot of products like TIPS that are tied to inflation expectations, since March, it's been the Federal Reserve through their QE program. They have bought an astounding $250 billion, $260 billion to be exact, dollars worth of TIPS securities over the last 4 months or so. Now, that's a gross basis. On a net, some of it's matured, so it's not been quite as big, but it still dwarfs anything that the private sector has been doing. Well, isn't that why we're seeing real yields plummet? And I've been arguing that has been it's given it a questionable signaling device as far as where the market thinks inflation is going to go, because the Fed's got such a heavy hand in that. Ben, do you have any thoughts or comments about the markets and the signaling that you're getting when you have the central bank involved to this degree?
Yeah, I think that it's two-pronged. Like we just said, it's the left side tail, it's evaporated, no right side tail, and exactly what you said, the liquidity premium and TIPS in general, and working at Arbor and fixed income, we get to see that on a daily basis, and what's happened to the bid asks, the overall liquidity, again, thanks to the Federal Reserve and their numerous programs purchasing of TIPS. That premium has essentially evaporated. And so we are left with an inflation premium that's kind of been muted to not really rebounded as much as this liquidity premium has pulled back. So that calls into question, just like you said, how much of this is real inflation worry. And I think that we don't know. We've had a nice core inflation print of around 60 basis points for last month, a big surprise, but flexible CPI began to recede, and a lot of that impetus was based on items that were heavily impaired by lockdowns.
Yeah, I definitely see that as well too. And if we're going to stick with the idea of inflation expectations and move on, there's another set of inflation expectations, and that's the surveys. The full disclosure, Ben and I in 2018 wrote a Bloomberg column talking about we're not big fans of surveys and that they're flawed and they have lots of problems as well too. But nevertheless, Federal Reserve believes a lot in surveys. They think that they're the gospel. And what you've seen in the surveys, which has been rather interesting, is, and again, I'm talking about here the Conference Board survey of inflation expectations, which is part of the Consumer Confidence Survey, University of Michigan's inflation expectations, which is part of its consumer confidence survey, is they asked, where do you think inflation is going to be in the next year? And there's been a sharp rise in inflation expectations over the next year. What do you think is going to be in the next 5 years? There's been a modest rise in that. But what's interesting is every other time the 1-year survey went up, you could correlate it to gas prices. Gas prices spiked up. Hurricane Katrina, when we hit $147 crude oil prices in 2008, you saw these surveys go up. Well, you don't have gas prices spiking right now, but you have a lot of people expecting inflation. Now, I'll say to you, I'm not entirely convinced that the surveys themselves are telling us where we're going to go, because they're surveys, and I have that doubt about surveys. But the Fed, the Fed, they've given whole speeches and said that they treat this stuff like the gospel. So they're looking at surveys as well too. But let me ask you, Ben, about alternative data. What are you seeing in the search trends on Google and some of the other alternative data as far as inflation expectations?
So inflation as a topic had jumped to about 2 to 3 standard deviations above average over really, coming into June, July, and that also was on the heels of this tremendous flows into TIPS ETFs. So it's a really quick segue. TIPS ETFs have accrued about $8.2 billion of flows over the rolling 3 months. So, and that's the largest on record. So there's this heightened amount of interest, and that's turned around and been fueled into questions by both the investment community and by consumers in general as to what the heck is going on with inflation. And what we've seen is, again, this 3 standard deviation event and search activity on the topic, that has actually peaked as of August 1st and begun to roll over ahead of this recent kind of pullback in inflation expectations, TIPS break-evens, that is. The big thing is all the searches that we were able to track for what causes inflation, what are people citing from ADAS models, all the way out to velocity of money, money supply, wealth effect, and so on. They are kind of all spread out across the board. So no one knows what is creating, why this inflation, why did we get this uptick in core inflation? Is it something that could last? That's being leaned on a lot in terms of leaned a lot on M2 money supply or M3 money supply. But again, they don't know how far it's going to go. And I think the proof is also in what type of inflation are we going to get. We have a fun chart that we do showing, is it stagflation, disinflation, deflation, hyperinflation, and all 3 of the non-deflation search trends are rocketing higher. So we think, oh, we're getting inflation, just like the consumer surveys you said, but we don't know necessarily why and how long. And I think that's why that 1-year versus 5-year outlook you just cited is so different.
Yeah, and we're going to have a real test here for the monetarists. As you mentioned, M2 year-over-year increase of 25%. That is the highest it's ever been by a long shot. I mean, we've never seen money supply growth to that level. If the Milton Friedman dictum to, inflation is everywhere and always a monetary phenomenon, then we should see it come back in a big way. And if we don't, well, we could just put monetarism to bed for good at that point, because if this doesn't produce inflation, nothing else is going to produce inflation. So far, we've talked about these expectations and understanding that the signaling might be a little bit, messed up because the Fed's got a big, heavy footprint in that market. They are telling us that inflation might be returning. And that gets me to the Fed. Their big thing, which is really a head scratcher, is that they're going to move from what is targeting inflation at 2% to an average inflation target of 2%. Okay, so you're going to change your target, but what does that mean for policy? Nothing. They're not going to change policy at all, not 1 inch. But yet they're going to say, that target of 2% inflation, which, by the way, we've never hit, now we're going to make it an average, and that maybe we'll see it happen as well too. They're signaling they're going to be a lot more willing to see inflation move up, although they're not changing their policies at all to try and cause that to happen. But I fear, or I think that the Fed is got this backwards. They're not in charge. If inflation moves up and interest rates stay stable, then they could say, oh, we could tolerate more inflation. But if inflation moves up and interest rates start to rise and rise a lot, the 10-year goes to over 1 to 1.25, just to throw out a number so you know what I'm thinking about when I say rise a lot. I don't mean it goes to 78 basis points. I mean, it goes up some more than that. Then the market might be telling the Fed it's time that you do something about this inflation, and they might have to change their course. So this has always been the case with the Fed, is that they make these rules. Oh, if X happens, we'll do this. If Y happens, we'll do this. If Z happens, we'll do this. And then they pat themselves on the back. Oh, we've got this all squared away and figured out. And then the market comes in and says, nope, you're going to go do this way. And then they go, okay, that's fine. We'll go do that too, as well. You know, famously in the fourth quarter of 18, you know, the balance sheet's going to be on autopilot when we reduce the balance sheet on autopilot. And, you know, and then the market freaked out. And then 2 weeks later, the Fed said, oh, we were just kidding. We're going to stop doing it. Please stop going down on markets and stuff. So I definitely see that the Fed is saying they're willing to tolerate more inflation. Question is whether or not the market is willing.
And that gets to flows too. So the issue with the Treasury market is, like you've said, there's been consistent, diminished, but consistent buying, 80 billion a month by the Federal Reserve. But investors on a flows basis, if you look at ETFs, have really left alone governments and sovereigns and U.S. Treasuries almost all together for 2 to 3 months. So the idea that that they could come in at some point and start to actually truly sell governments on a larger scale, I think could be true. And what would actually drive that, I think, would be kind of there's two kind of key things that could happen. One being the commodity space. We've started to finally see a rebound in industrial metals. So copper, zinc, and tin have finally produced year-over-year positive gains. Overall, the commodities space in general is producing, I think 42% of commodities are actually gaining. And that's on the heels of what has actually been a surprising somewhat rebound in the industrial space. So we have this industrial economy. China needed scrap metals, copper, and aluminum, and because their imports had dropped by 50%, they've come out there. We saw that in search activity that's been realized now in higher prices. And I think as that inertia continues for the industrial side, if the consumer can hang in there, things look good for inflation to potentially rise. Now, the big question mark is the job market broken? Will FPUC payments ultimately finally bite? And will those personal incomes that are up 4% year over year, that would be down 6% without the payments, is that going to come back and haunt us? So the other thing real quickly too is something that both Jim and I have spoken a lot about, is globalization. So now that we are kind of on the, we would hope maybe on the back half here of COVID-19, probably not, but let's hope so. Globalization and the deceleration in that we've seen since early 2018 has a history based on looking back to 1970s of producing inflation. As you see regionalization, hubs that are created, that's more of the 21, 22 story, but that's kind of the next leg. If we get this continued revival and can keep this inertia going, and then kind of have this unfortunate situation of deglobalization, that could add fuel to the fire. Now, none of us are talking about inflation going gangbusters at this moment, but that is a potential path, if you will.
Yeah, you know, just when we talk about inflation, you know, it really depends on how old the listener is. If we have older listeners, you know, in their 60s or something like that, oh, they're thinking 15% inflation or 10% inflation, you know, like we saw in 1980. If we have millennial viewers, listeners, they might think, oh, high inflation, that's 2.5%, because the core PCE, that's the Fed's favorite measure, hasn't been above 2.5%, which a lot of older people don't think is inflation. It hasn't been above that number since 1992. So it's been almost 30 years since we've actually seen inflation that high. I think that's what we're talking about when it comes to inflation. I also want to underscore something else you were talking about too. You know, the famous acronym DGT, which is demographics, globalization, and technology. Those are the three things that have probably kept inflation down for the last several decades. As we get older, and the demographics as we get older gives us more savers to help us push it down. Globalization, as you just talked about, has helped us to create more inefficiencies. Maybe we're seeing a reversal of that. Technology has definitely been a big driver of keeping inflation at bay, because the minute that some type of inefficiency occurs, that prices go up, technology's there to kind of help us push it down. So even if we were to just see a couple of those things like globalization wane a little bit, we could see that 2.5% inflation rate, which we haven't seen in 28 years on the core inflation number. So when we talk about inflation, and I talk about, well, the market might react to it, I'm not suggesting 7 or 8 or 10% inflation. We don't need it to be that extreme like we did in the late 70s or in the early 80s as well. It wouldn't take much in order to see the inflation rates go higher. Last thought for you when it comes to the inflation levels is we talked about the stimulus and stuff. Remember now, economic growth is contracted by, on an annualized basis, 32% in the second quarter, which is about 9% real. But the amount of stuff, supply that we're making is down. The unemployment rate is officially 11%. Some people think it might be a little bit higher, but even at 11%, it's the highest level it's been since the Great Depression. We're producing less stuff. Stimulus-wise, we were giving people an extra $600 a week for unemployment, a $1,200 stimulus check, promising to bail out a lot of other industries. So we're stimulating demand. Less supply stimulating demand should lead to higher prices over time, and especially if we get more of that stimulus. Now, we are stuck, as we talk here, that the Democrats are proposing to the Republicans a more Republican-friendly version of the stimulus to try and get something passed. Nothing's happening, excuse me, on that, but maybe it will. But if it does, I do think it all leads to the idea that we might start to see inflation creep up over the next couple of, next couple of years, 21, 22. Ben, you got any final thoughts on this?
Yeah, so you think you brought up a good point is this is what's got everyone really hot on this topic is the core inflation print, again, 60 basis points highest since January 1991. Core inflation, this gets into what you're just talking about, is something that drops and creates a new regime, a new average after every single recession. That's what's happened since the 1980s. This recession, if we see this rise in core inflation and we're able to maintain that, even I think for a number of months, this scenario of what you've discussed, where fine, we've crimped supply, maybe that industrial economy, if it doesn't come back like we're kind of seeing it do right now, and we have this ample fiscal policy, I think that is a recipe for potentially seeing a game changer in that we'd have the first rise in core inflation after recession since the 1980s, since I was effectively born. And I think that would be, yeah, I know, right? And I think that would be really the game changer going forward. And so I think, the bottom line is that for investors, it seems like they've placed a floor in inflation expectations at that 1.5% mark. That's evidenced in TIPS break-evens. It seems like there's logical kind of buy points at 150 basis points moving forward from 5 years on out the curve. And I think that will remain firm as we move forward. And we really got to watch these core inflation prints for the next 2 to 3 months, because that, if they do hold, that's going to feed into exactly what Jim was just saying, and that creates a kind of a new environment for all of us.
Yeah, I would agree. We'll really have to see. But Ben, let me throw out one last question at you. I know we didn't talk about it in the pregame, but I'll do a jump ball here. We're in lockdown mode, and our spending habits have changed. We're not, spending as much money as restaurants because they're not open anymore. How accurate do you think the measures of inflation are, especially at the core level, the basket that they're measuring versus the new basket that we're actually purchasing in this post-March period of this lockdown and partial reopening? Do you think that those measures will have to change over the next couple of years or so, or do you still think it's a fairly accurate description of how we spend our money?
Yeah, I mean, this is a huge debate, of course, especially with items like healthcare and tuition that have just rocketed. And unfortunately, a lot of us are still paying those tuition fees, even though, kids aren't in schools. But that aside, I think the core inflation metrics are still a quality group to watch. And especially when we break it down by flexible and sticky CPI, the sticky prices, anything like laundromat prices, or things that typically tend to not change that much over time. Those are what have been, and what you've been talking about too for so long, really the dead components of inflation that have been kind of left alone and really not even considered. So, I mean, I think that, yes, I think the core measures that they are talking about specifically within the sticky realm are the ones we do want to focus on, the boring, old, metrics that have just died off. And I think that if we get the balance and recovery there in what CPI is truly measuring, I know this isn't going to include the stuff that's really rocketing higher, or really able to capture maybe technology in the way that we think it should. I still think those are potentially going to be the game changer. So I would say yes. I think that core sticky items for once are going to be watched, whereas we didn't even have to look at them for years.
I think that we've covered the inflation topic pretty good here. Kristen, you want to finish this up here and with telling people more about what we do?
Yes, absolutely. Just wanted to thank both of you, Jim and Ben, for your thoughts on inflation. I thought that was a very healthy topic today. Appreciate your thoughts and time that you put into this. And thank you for our audience for joining us today. For further information on Arbor Research, Bianco Research, and Arbor Data Science, please feel free to contact Gus Handler. I've included his email address here in the slide as well. So thank you all and have a great day.